I'm Kevin Hincks, rejoined now by Jonathan Honig and Scott Bauer. Guys, the market it's rallied up to this point, and then for the last two segments here, it's kind of sitting. It's unwilling to go any further, I think, until Jerome Powell speaks. Exactly right. And it's only about 15 minutes away till he starts speaking here at 11 o'clock Chicago time. So I think this market is taking a breath here.
It is an interestingly, you see a market rally like this with S&P's up 10, Dow's up almost 200 points, yet the VIX is slightly positive. We'll call it unchanged.
Yeah.
On any normal day, any normal rally, we'd actually see VIX down a little bit like this. Right now, that in and of itself.
Is that because of the anticipation for Powell?
Yes, in and of itself, and is it the anticipation of what is going to come out over the next hour or so?
Let's take a look at something else here and look at if the SPX is giving us any kind of an expected move here. No, so far nothing. Although, no, the vols are sitting in their normal way. So okay, I thought maybe there would be a little built-in move in the SPX, but no. Okay, so let's go to our first stock of the day, which has earnings tomorrow morning, which is Dollar Tree. Now, Andy Swan just did a great piece where he said there's a little divergence here. His data is looking more bullish on Dollar Tree after, frankly, we looked on the chart, 3 quarterly misses of earnings in a row, right, based off their acquisition of Family Dollar. But he sees his data is showing some positive trends in Dollar Tree. And if that's the case, you've got some opportunities here. You've got a stock that's moved from the 116 level down into, the low 80s after going into the 70s here. So you've got, the only thing is, guys, I could say that about a lot of stocks right now.
I mean, that's what makes it so fascinating.
There's a blue light special going on all over the place.
And oftentimes these cheap stocks continue to get cheaper. I mean, it's a rough chart, but what's so fascinating about how you use options is that you're able to structure these positions that are based on time, they're based on volatility, that make money even if the stock goes nowhere.
Limited amount of risk that gives us the ability to take advantage of time and movement. Direction and duration, I like to call it. All right, guys, Dollar Tree. You've got to expect a move, not a small move here. And you've got a stock, like I said, if we go back to put up a little longer chart, like a 3-year chart, look at that. I mean, now this stock can't say it can't go lower because it can. That 3-year chart shows us it can go a little bit lower. So what are we thinking here in Dollar Tree? This has got 14,000 plus stores open. So if they get it right, they've got the the scale to do this well. Now, what do you got? What are you thinking here, Scott Bauer? Tell me.
Well, my first gut is always to look at selling some premium, which much like we did in the last segment, I like
104 vol on the front.
I like looking at an iron condor, playing both sides, and then you play for the expected move, which you had said is about $5.75 or so.
Yep.
So looking at something to the upside of around 88 and something to the downside of maybe 76, 77 as my break evens. Now that only works for me again, Kevin, if you can get the appropriate amount of credit, the appropriate reward for that risk. But that would be my first look at what I would want to do here.
Yeah, the move for the day is $5.70, but the move for the rest of the week is still $6. So if you go around $6, you're covering both your bases there on that. So 82, that gets us down to about 76.
So I'm looking at maybe the 77.5, 75.
Okay.
$2.50 wide to the downside.
I like how aggressive we're getting here.
This expires in a couple of days.
This is an earnings play. This is
total earnings play.
So 77.5, 75?
Yep, $2.50 on the downside. And then going up to the upside here, maybe we look at the 87.5, 90.
87.5. A couple more strikes.
I have to say, this looks confusing oftentimes, but once you get the basics of what charts like this and spreadsheets like this understand it.
We have to go to 89.5.
Let's you get right away.
87, 89.5 then. The beautiful thing about this, Jonathan, is you look at something like this and it sounds confusing, right? Iron condor. Oh my God, what's an iron condor? But when you break it down to its most basic strategy, all it is a call spread and a put spread. It just has a fancy name to it.
87, 89.5, did you say? Oh, you know what?
There we
go. More
go.
Strikes. Here they came.
There we go.
So pick your same strikes
back
again.
To 87.5, 90. And if I can get somewhere over $1 for this, I'm in.
You're right,
Right there.
Nice call. Right at $1 credit. So that's about, what's that, 40% of a no, it's about 60% of a dollar and a half strike.
Yeah, it's $1 to
2.5 strikes. Sorry.
$1.5 risk.
Right.
I can make $1 here. My break evens are 76.5 and 88.5. So those break evens put me almost right at that $6 move on either side here.
Right. So that's a good point there, because you can not only use the short strikes, but the short strikes are not where this breaks even. The short strike is that plus the premium that you took in.
So as long as, in my understanding, so basically as long as it stays between 76.5 and 88.5 by the end of the week, you make money.
Exactly. That's where, and you can put those on your screen on the Thinkorswim platform right there, because it's the short strike plus
the credit
that you took in is where the spread would break even.
I have to say, we always say, oh, you're either a gambler or a long-term investor, right. And this is an example of a shorter-term investment that isn't a gamble, that is risk-defined.
Right.
That if and some of these, Kevin, I always marvel at some of these strategies. I remember so many of the traders, having to draw these charts and stuff by hand on little pieces of paper to map out all these. So what this platform offers you is pretty impressive.
All right, so there's we now have a Dollar Tree in. Now let's go to the other one that we're looking at here, and that's Apple. Apple, probably one of the widest held names at TD Ameritrade all over the world, and you can see the chart on Apple. There's the 3-year chart. So it's back to a pretty significant level here, right around 176, as you can see. If you look at the year chart, it's even more pronounced, as you can see. But there's a level that it spent a fair amount of time here, which is 171. Ben Watson just did a great breakdown of the oversold aspect of this and where it needs and how far it's come down. So how are you talking to Prosper Trading Academy clients about Apple? I'm sure a lot of them have some type of position, either stock or options in Apple. How are you attacking this?
A lot of stock replacement talk.
Exactly.
Which we talk about here all the time.
All the time.
And, buying a deeper in the money call, that's a little bit further out, and selling an above the market or out of the money call against it. That's one strategy. Another strategy is to sell some near-term downside put spreads.
Yep.
Give you the opportunity to get in back at that 172, 170 level, structure it anywhere you want. But I like the stock replacement here because, like we talked about just previously, we get to take advantage of a short option in the near term where we're going to start collecting theta against a longer term higher delta option, which isn't going to lose theta as quickly.
Right. Now, Scott, here's the 170, 185. Now, we went out 107 days to next March to give us plenty of time here. And now against that, we're selling only 9 days out, the 185 call. And as you see, we're paying about $15 for that, but time is on our side on this. We've got 107 days basically to make this work. So let's throw this on the Analyze tab and take a nice look at it here. And as you can see, this is a bullish play. You can see the deltas. It's 110. That's a 5 lot. So about, what's that, 22 deltas per spread. So if you do it once, but remember, all you have at risk on this trade is the $15. So if you did one time, it's $1,500. That allows you to trade Apple even though you have a smaller account. If you have a larger account, it allows you to trade more of them, right? So without the heavy margin that trading 100 shares of Apple would do. It's about a tenth, right? And you could trade for 107 days. So here's the look that we have in Apple, Scott. Let's do a mini lesson here on rolling.
Okay.
We've got about 60 seconds here.
Yes.
Because this is one that you're going to have to roll, right? And extend duration on.
Absolutely. So over the next 8 days or so till the December 7th expiration, best thing that can happen to this position is a grind towards that short 185. Yep. Let's say that happens. Then like you said, we have the opportunity either to take the trade off Or we buy back that 185, which theta has been in our favor, is probably down to a dime, 15 cents. We sell another option going out another couple weeks.
Extend duration.
Extend duration, and maybe we then sell up at the 190 or 192 and a half to keep that bullish bias that we have going on there.
And
All
it's
right. Go
quickly,
ahead.
just fascinating.
Yes.
I mean, it's so much in the follow-up. We oftentimes think either you're right or you're wrong
Not
on a
at
stock,
all.
and that's it. And I mean, these ideas
This
how
gives you a lot of time to be right.
and how to follow it up with a subsequent position.
All right, that does it for our show today, everyone. I want to thank Scott Bauer for coming in and Jonathan Honig.
Thank you. Great to be with you.
All right.
Thank you.
Please tune in tomorrow for another edition of Fast Market, tomorrow at 10 a.m. Central, right here on the TD Ameritrade Network. Have a great day, everybody.